Welcome back to the Longacres Finance channel. As we come close to the end of February, it's time to take a look at the most attractive dividend aristocrats to consider in the upcoming month. My personal view on stock selection is to keep it as simple as possible. This way there is less room for mistakes. I have come up with two simple strategies for selecting the best dividend aristocrats each month, and a third strategy that is a blend of the first two. Each strategy is simple to understand and follow, and they are built around simple principles that should reward investors with above average results over long periods of time. The first strategy is to target dividend aristocrats with the most attractive price, and leverage the long-term impact of undervaluation. The second strategy is to target dividend aristocrats that are poised to grow the fastest in the near future, with the intention that this growth will be reflected in terms of total return to investors. The third strategy blends these two concepts, and aims to offer a mixture of both undervalued aristocrats with a focus on the ones that are poised for faster growth in the future. I started tracking these strategies back in August of 2021. So through month-end January, I have 6 months of data to analyze. The goal for each strategy is to outperform NOBL, the Dividend Aristocrat exchange-traded fund, over a long period of time. For me, a long period of time would be 5 years and beyond. So while we are still far away from seeing whether these strategies have merit in the long term, we can at least get a sense of how they are doing thus far. Over the last 6 months, each strategy is outperforming NOBL by more than 4%. That's a sizable cushion for a 6-month period. These strategies haven't beaten NOBL every month, and I am not expecting that they will. But I do think they have the potential to offer significant upside over NOBL in the coming years. So let's take a look at the dividend aristocrats selected for each strategy in March, and I'll also dive deeper into past results. Before we dive in though, there have been a few changes to the dividend aristocrat list this month. AT&T has finally fallen off, and we also lost Leggett & Platt as the stock dropped out of the S&P 500 index, which happens to be one of the conditions for a company to be a dividend aristocrat. 2 new companies have joined the list as well. Brown & Brown, the insurance provider, and Church & Dwight, the household product manufacturer, are officially on the list. It's nice to have 2 additional companies to select from, but it's unfortunate that we have lost 2 long-time aristocrats. Let's see if either of the 2 new aristocrats make the cut for March. Strategy number 1 is the most undervalued strategy. Here I am using dividend yield theory to identify the potentially undervalued aristocrats right now. By comparing the current dividend yield to the trailing historical dividend yield, we can get a quick valuation estimate. The 10 most potentially undervalued aristocrats right now are Atmos Energy, Franklin Resources, Clorox, Ecolab, IBM, Medtronic, 3M Company, T. Rowe Price Group, VF Corporation, and Walgreens. Collectively, these 10 companies sport a dividend yield of about 3.3%, which is a cool 1% higher than the average dividend yield of all 65 dividend aristocrats. During the past 6 months, we've seen 21 unique dividend aristocrats pop up on the 10 most undervalued list. This month that number expands to 23, as Ecolab and T. Rowe Price are appearing here for the very first time. This strategy got off to a rocky start, trailing NOBL for the first 4 months, but it took off in December, gaining almost 5% of alpha over NOBL. January worked out great as well, as the strategy lost 0.84% to NOBL's 4.05% loss. The past 6-month return for the most undervalued strategy is 9.9%, which is 7.68% better than NOBL. February isn't working out as great thus far. Through February 18th, NOBL is down 2.68%, and the 10 most undervalued aristocrats for February are down 3.98%. This 1.31% preliminary loss will erode some of the 7.68% cushion, but the strategy should remain about 5.5% ahead of NOBL after February. There's also a week of market activity that may change this gap. A much more friendly and popular dividend investing approach is the buy and hold approach. With this approach, you would buy shares of quality dividend companies like the aristocrats and hold on ideally forever. I've been tracking how such an approach would have worked out for the most undervalued strategy. It would be quite easy to implement. You would simply invest equally amongst the 10 most undervalued dividend aristocrats each month and hold these positions forever. The 6-month return for the buy and hold approach is 10.18%, which is 0.28% better than the individual strategy. It's nice to see this approach is holding its own versus the actual strategy. Moving on to strategy number 2, the dividend aristocrats that are poised to grow the fastest. It's very difficult to predict which stocks will grow faster than others. If we could do so with a high degree of accuracy, we could stand to earn considerable returns from the market. My formula to estimate how fast a given aristocrat will grow is as follows. I take the forecasted earnings per share growth rate for the next 5 years. Historically, there has been a correlation between earnings growth and capital appreciation, so we can assume that companies that will grow their earnings faster also stand to offer higher capital appreciation. To this forecast, I add the current dividend yield, which is an almost guaranteed rate of return. And finally, I tack on the potential growth or decline from a return to fair value based on dividend yield theory. This assumption is made for a 5-year period, and then annualized back to compute a potential annual rate of return for each aristocrat. What isn't built into this figure is dividend growth. I'll call this icing on the cake that will boost each actual return. I also built in a margin of safety into this forecast to keep it as conservative as possible. Each month for strategy number 2, I select the 10 Dividend Aristocrats with the highest annual return assumption. The chosen Aristocrats for next month are Caterpillar, Chubb, Ecolab, IBM, 3M Company, Nucor, PPG Industries, Cisco, T. Rowe Price Group, and VF Corporation. Collectively, this bunch offers a 2.62% dividend yield, that is about 0.3% better than the average dividend yield of all 65 Aristocrats. But a high dividend yield is not the main focus here. Instead, I am expecting these 10 Aristocrats to offer the best total return over the next 5 years, based on their price today. Keep in mind that this is a quantitative approach to stock selection, and it doesn't consider any other factors. There can be many other reasons why a given aristocrat is unlikely to perform well in the future, and you should always do further due diligence. This strategy started off the best, beating NOBL for the first 3 months. It then trailed the ETF in November and again in January, with a modest beat in December. The trailing 6-month return for strategy number 2 is 6.86%, which is 4.63% better than NOBL. It is, however, doing worse than the most undervalued strategy, with a lag of about 3%. February is shaping up to be another strong month for strategy number 2. If you recall, NOBL is down 2.68% through February 18th. Strategy number 2 is down only 1.44%, generating 1.24% of alpha with a week left to go. This alpha would bring the strategy about 5.3% ahead of NOBL, and only about 0.2% behind the most undervalued strategy after February. The buy and hold approach for strategy number 2 is performing in line with the strategy through January, offering 4.46% of alpha over NOBL and trailing the individual strategy by 0.17%. And finally, we have the blended strategy that aims to combine the benefits of the most undervalued and fastest growth strategies. Here I am looking for dividend aristocrats poised for the fastest growth, but only amongst potentially undervalued aristocrats. The 10 chosen companies for March are Air Products and Chemicals, Cintas, Ecolab, IBM, Medtronic, 3M Company, Stanley Black & Decker, T. Rowe Price Group, VF Corporation, and Walgreens. Collectively, these 10 aristocrats offer a 2.9% dividend yield right now, which places it right in between the first 2 strategies. The blended strategy got off to a slower start, but it has beaten NOBL for 5 out of the last 6 months. It is also currently the best performing strategy, with a return of 10.49%, placing it 8.26% ahead of NOBL. February is not shaping up to be a good month for the blended strategy. Through February 18th, it is down 4.9%, underperforming NOBL by 2.23%. This return would push the blended strategy below the first 2 strategies, so we will see if it can bounce back a little during the last week of February. The buy and hold approach for the blended strategy is coming up a little short of the individual multi-selections. Over the last 6 months, it has a return of 8.41%, which is 6.19% better than NOBL, but also 2.08% below the individual multi-selections. I think this gap will narrow over time, and honestly I would expect the buy and hold portfolios to be right in line with the individual strategies after a few years of analysis. I have a live Google spreadsheet that is continuously updating all of this information for each dividend aristocrat. I share this file with my Patreon members. So if you'd like to see the most undervalued aristocrats or the ones poised for the fastest growth on any given day, you can join my Patreon and check it out for free. If you don't like it, you can cancel anytime. With that, I'll wrap it up for today. If you enjoyed the video, be sure to give it a like and subscribe to the channel for more content. Thank you for watching and see you next time.